What if you could build a fortune and the tax man could never touch it? For millions, this isn't a dream. It's a strategy. But the path to tax-free wealth looks dramatically different depending on where you live. In the United States, it's a fortress built with your employer. In the UK, it's a personal shield you control completely. And in Canada, it's a flexible hybrid of both. In the next 8 minutes, we're putting the 3 most powerful wealth-building systems head-to-head. America's 401k, Britain's ISA, and Canada's RRSP. We'll break down how they're taxed, how much you can contribute, and the hidden advantages of each. By the end, you'll understand which system reigns supreme and how to master the rules where you live. Let's start in the United States, with a system built on the foundation of employment, the 401k. Think of it as a partnership. The traditional 401k's primary power is its upfront tax break. When you contribute, the money is taken from your paycheck before income tax is calculated. This lowers your taxable income for the year, meaning you pay less tax today. Your investments then grow tax deferred, meaning you don't pay any tax on the gains year after year. But the 401k's most famous feature is the employer match. Many companies will match your contributions up to a certain percentage of your salary. This is the closest thing to free money in the investing world. Not taking full advantage of your employer match is like turning down a guaranteed 100% return on your investment. The US also offers a powerful alternative, the Roth account, available as both a 401k and an IRA. With a Roth, you contribute with money you've already paid tax on. There's no upfront tax break, but the payoff is immense. All of your investment growth and your withdrawals in retirement are completely 100% tax-free. Now, let's cross the Atlantic to the United Kingdom, where the system is defined by one word: simplicity. Meet the ISA. The Stocks and Shares ISA, or Individual Savings Account, is not an investment itself, but a powerful tax-free wrapper you can put your investments inside. You contribute with post-tax money, similar to a Roth. But once inside the ISA, your money is shielded. It grows completely free of capital gains tax and dividend tax. And when you take it out, it's all yours, tax-free. The ISA's beauty lies in its flexibility. Unlike a 401k, it's not tied to your employer. You can open one with dozens of providers and invest in almost anything you want. The annual contribution limit is generous, at £20,000 per tax year. And crucially, with many providers, you can withdraw your money at any time for any reason without penalty. It's your money, under your control. Finally, we head to Canada, home to a uniquely flexible system that offers the best of both worlds. The Registered Retirement Savings Plan, or RRSP, functions much like a traditional 401k. You contribute with pre-tax income, which reduces your taxable income for the year, giving you a valuable tax deduction. Your investments grow tax-deferred, and you pay income tax on withdrawals in retirement, when your tax rate is likely to be lower. But the RRSP has a secret weapon that the 401k lacks: contribution room carry forward. If you don't use your full contribution limit in 1 year, the unused room is added to your limit for future years. This is incredibly powerful for those whose income grows over time, allowing you to make large, tax-deductible contributions when you're in your highest earning years. Canada's other powerhouse is the Tax-Free Savings Account, or TFSA. Don't let the name fool you. It's a powerful investment account. Like the UK's ISA, you contribute with after-tax dollars. All investment growth, capital gains, dividends, interest, is completely tax-free, and so are all withdrawals. It's the perfect partner to the tax-deferred RRSP. So we have 3 powerful systems: the employer-boosted 401k, the flexible ISA, and the hybrid Canadian model. How do they stack up side by side? Let's break it down. For tax on contributions, the US 401k and Canadian RRSP offer a pre-tax advantage, lowering your tax bill today. The UK ISA and Canadian TFSA are post-tax, For tax on withdrawals, the roles are reversed. The ISA and TFSA are completely tax-free, a huge advantage. The 401k and RRSP are taxed as income. For employer matching, the US 401k is the clear winner, offering a massive boost to savings. This is less common in Canada and non-existent for the ISA. For flexibility, the UK ISA is king, with easy, penalty-free access to your money. The Canadian TFSA is also highly flexible. The 401k and RRSP are more restrictive, designed strictly for retirement. So, which is best? There's no single answer. The US system is unbeatable if you have a generous employer match. The UK system offers unparalleled flexibility and tax-free simplicity. And the Canadian system provides a brilliant strategic combination of upfront tax breaks and tax-free growth. The key is to understand the rules of your home ground and use them to their absolute maximum potential. Want a deeper dive into the specific strategies for your country? Subscribe to Investly for our upcoming masterclasses on the 401k, ISA, and RRSP. Master your money. Build your future. Comment below so I can get you inside one of them.